This is Daybreak Asia. We're counting down to Asia's major market opens. And Haidi, pretty big eco week ahead. I mean, US inflation front and center for us, especially following those University of Michigan survey results on Friday. But also you've got those numbers coming out of China as well.
Yeah, really, really dire numbers when it comes to credit demand, be it you look at households or corporates, right? And it kind of pulls into view again just the difficulties that Beijing policymakers are working with, even as I think some parts of the market have really kind of run with a narrative that we've had a few good prints on certain parts of the economy, but clearly the challenge is still front and center there.
Yeah, absolutely. We've got the open here of Japan, South Korea and Australia at the start of the day here in Japan. We are watching the Nikkei 225 coming online this morning. It's the last close from Friday, but fairly flat so far. So sort of tracks the session that we had on Wall Street on Friday. As we said, that University of Michigan survey coming in showing a little bit of deteriorating sentiment. Sets the tone perhaps for inflation numbers that are due later this week. And all important, of course, what it means for the Fed. Japanese yen, you're just continuing to track that slight decline. We did see it firming up, of course, following the two possible bouts of intervention last week. But today we are getting a lot closer to that 156 level at this point in time. And, of course, we're also keeping a track on whether that becomes a net negative for investors as well. BlackRock is the latest, saying that the yen weakness could actually deter foreigners from Japanese equities, even though we have traditionally seen it being a boost to the exporting names. Now it's that big question mark whether the weak yen is starting to hurt consumption instead. Let's switch on, take a quick look at what's happening in Korea at the start of the day here. A bit of trade data to note, because we do get the 10-day trade data from South Korea that drops on this day. We are just waiting for those numbers to come out. And exports, you can see there, are gaining 16.5% on the year. Korea, of course, a trade bellwether, not just for this region, but also for the global economy. Imports are declining nearly 7% on the year, Haidi.
Take a look, Belle, in terms of how we're just starting to come online when it comes to the staggered open here in Sydney. Pretty flat at the moment for the ASX 200. This is a market coming off, about 3 weeks of consecutive gains, so perhaps a little bit of a breather being taken there. One of the stocks we're watching will be ANZ, the group really saying that, confirming the reporting that Australia's regulator is investigating the execution of a government bond issuance last year. ANZ saying the inquiries relate to the issuance of 10-year Treasury bonds by the Australian Office of Financial Management, and they are fully cooperating with ASIC. So we're still trying to get a few more details, but a bit of downside, 3.6% to the downside for ANZ Bank there. Watching bonds as well, of course, really traders, be it you talk about Australian bond traders, but also Treasury traders, just waiting for that CPI to kind of fuel or potentially go in the opposite direction for the market rally. We have seen, of course, that rebound for Treasuries this month. The signs of cooling in the labour market really at play there. Also watching oil edging a little bit lower this morning. Iraq's missed messaging really putting the spotlight on what to expect from OPEC Plus. Iraq saying that they wouldn't agree to more output cuts at the next meeting. That really raises the stakes in the run-up to June 1st, which is when that meeting is scheduled to be. We've seen Brent trading under almost now, under that $83 a barrel, losing almost 1.5% in the Friday session. WTI at about $78 there as well. So much of the advance we've seen so far this year for crude has been underpinned by these supply cuts from OPEC Plus. So a lot at play. Quick look at treasuries, as I mentioned. Really, it's wait and see when it comes to the CPI print. The April Consumer Price Index numbers due out on Wednesday. It could be, Bill, really the biggest test yet in terms of where this rally goes, these Fed expectations, and where those the Fed cut expectations will fall as well.
Yeah, that's right. Ramifications across a lot of different asset classes. But let's bring in our next guest, who says investing outside the outperformers is intriguing given market narrowness and a benign backdrop. With us now is George Morris. He's CIO and Global Head of Equities at Principal Asset Management. And George, what do you make of the dynamic that we're seeing in the market at the moment? Because that emphasis and that enthusiasm around big tech, around around AI as well, just continued into 2024. Do you want to be looking outside of those names, though, at this point in time?
I do. It's not as if big tech isn't compelling and intriguing. It's just everybody knows it. There's been an incredible herding and momentum behind there. And we've seen last year was the strongest momentum year we've seen in a long time. The first quarter was a very strong momentum year. And it's leaving opportunities available elsewhere, especially in an economy, global economy that's actually relatively stable.
When you look at the opportunities, though, that are outside tech or outside AI, is it about finding new opportunities in those sectors or downstream different applications, or is it just about looking at something completely different instead?
So it's both. So one, there are the derivative plays with respect to AI. Everybody's loaded into the first order plays, NVIDIA's and things like that have just done brilliantly. But it's also the second order plays. So for example, Microsoft is thinking of investing a $100 billion data center. Who's going to funnel all the work that goes into it? Everything from bulldozers to copper. And so I think there's opportunities across that. And moreover, if we have a more stable economic environment, there's going to be a cyclical recovery in a lot of activity. And I think there's opportunities outside of just things that are AI secularly driven.
We actually just, as I mentioned earlier, we had that University of Michigan survey result coming out, though. It did just show consumer sentiment starting to weaken a little bit. We saw it showing up in results, for instance, from Starbucks or McDonald's. Are you concerned about the U.S. consumer at all?
For sure, and I think the U.S. consumer is bifurcated in two ways. One, there's the high end that is still holding up. It's holding up because equity values and home values have held in, and they can trade off of that, and they feel wealthy. The folks that are not, they're feeling inflation bite. It's biting harder than their wages are going up, and you're starting to see credit deteriorate. So you've got a dual speed consumer in the U.S., and I think it's something worth noting.
George, the contrarian call on China has become a little less contrarian in recent weeks, but the data over the weekend, it sort of puts into sharp relief just the massive structural slowdown that the government is dealing with there, right? Where do you see the opportunities? Yes, valuations are still cheap, but how selective are you in this market?
So I have a slightly different take on the China credit data. Well, first of all, at headline, it's not great. We're seeing that slowing impulse. It's a sign of a weak, aggregated economy, and the credit impulse reflects that. But it also highlighted one of the big critiques of China for the last decade plus has been heavy leverage. You've seen a lot of spending going on everywhere, and it's a lot debt finance. So to see a restructuring in a more healthy way, see less debt impulse, isn't necessarily a negative from the long-term perspective of China. And I also think what's really intriguing about China isn't necessarily the more cyclically oriented areas of the economy. It's the more secularly oriented areas. We've got a lot of Chinese companies that have fantastic business models, where outside of China, those business models have been rewarded handsomely. In China, they haven't. To me, that's the opportunity at play.
So I agree with a lot of what you've just said, but so after the difficult restructuring to the new normal, which of the sectors do you think will benefit?
So within China, frankly, I love technology and communications. Those are the spaces where they've been hit the hardest the last several years. People had flown into them and then have run away, partly because of worries over government policy, which have felt pretty heavy-handed with respect to governing those sectors in the last few years. That feels like it's alleviating. We're seeing actions that are much more balanced going forward. And there's also been a concern that these companies are getting left behind their Western counterparts, and in some ways they may be. The other hand, part of this whole global restructuring that we're seeing with respect to geopolitical alliances is creating much more of a closed set for companies doing business within China. And I think companies within China that can serve the Chinese market, whether it's consumer or business, will be better off. And I think a lot of the big Chinese technology companies are very well placed for that and are not priced for it.
I'm glad you mentioned geopolitics. Obviously, we're still digesting the implications of the quadrupling of tariffs on Chinese EVs being proposed by President Biden. How much volatility are you expecting to come out as we get closer and beyond November? Do you think there's going to be meaningful challenges for Chinese companies going forward?
So first order, I think these tariffs that are being contemplated and being levied, I think they're really just for headlines, and they're not really impacting the economy much. You don't see Chinese EVs selling within the United States already. This is really for headlines, to be fair. I think a bigger concern is what happens post-elections this year in the United States, whether there is going to be any sort of rapprochement between China and the United States, or will there be a hardening of tensions. Right now, things are pretty bad. Hopefully they don't get worse, but I think that a lot of that negativity is already reflected into Chinese equities. We've seen 3 consecutive negative years. We've never seen that before. All you need is a bit of less bad news to get things rolling again.
Less bad news actually makes me think of new sentiment around China, and it can be pretty anti-China in the US in particular. And a lot of the guests that we speak to are just very disinclined to invest in the market. Do you think that there's a full understanding of China's economy in other parts of the world? And do you think there's perhaps the chance that any opportunities are being left on the table?
I think for sure there are opportunities left being on the table. I think one of the issues China has is it's relatively opaque. That lack of transparency is causing a great amount of distrust, especially when you see regulatory action upend things pretty quickly. And you've just seen people say, it's not worth it, I'm going to move on with life. And they're ignoring some of the positive steps that are being undertaken to get investor confidence back into China occurring. So I do think, there's substantial negativity. I think that negativity is well overdone, and it's creating massive opportunities. And what's interesting is there'll be a lot of criticism over China actions from a regulatory perspective, whether it was with respect to the for-profit educational companies, whether it's regulation on the big tech companies. Well, we've seen that similar regulation happen in the West. We've seen certainly Europe attack big tech quite dramatically. We've seen the United States take out the for-profit educational companies. Yet Western investors shut those aside, and if it happens in China, they get very panicky. I think that's an opportunity.
George, really great to have you with us. George Maras, CIO and Global Head of Equities at Principal Asset Management. Take a look at some of the early movers that we're seeing in Japan and also here in Australia. These are the ones that we've been watching. Honda, of course, they were expected to be an outperformer out of the Japanese automakers reporting, and we do have some pretty positive numbers there that investors are reacting to. We're seeing upside of over 4% there. In fact, that's actually off the session highs of over 6%. That was the most in 3 years. We've seen trading volumes also triple for this stock as well after they boosted buybacks, seeing another record year on hybrids when it comes to profits from hybrids, I should say, particularly in the US market, and also two-wheeler demand in Asia as well. So Japan's second largest automaker doing pretty well in the session today. We're also watching Tokyo Electron, and actually it is actually doing quite a bit better than perhaps expected, given that full year operating profit and income forecasts all missing estimates, seeing upside of about 1.3% there. Also watching SoftBank, expecting earnings, of course, a lot to go through there, set to return to profit after that shift to AI and the demand for chips. That's really kind of what Bloomberg Economics is expecting as well. We're also seeing that this selling of Vision Fund assets at play there as well. Masa really pivoting to AI and chips and away from that aggressive VC strategy. And taking a look at stocks that are moving in Sydney, ANZ is really the one that we're watching most closely there, as we see ANZ Group this morning saying that the regulator is investigating an Australian bond issuance case there. When it comes to downside, we're seeing a little bit of pressure there on ANZ at the moment, down about 3.5%. The execution by the bank of a government bond issuance is in question in terms of these 10-year Treasury bonds by the Australian Office of Financial Management. Bell.
Yeah, Heidi, we'll have more on the Australia topic ahead, or Australia theme. Hearing from the Treasury sees inflation returning to target by year-end. We're going to have an interview with Treasurer Jim Chalmers coming up later this hour and ahead of Tuesday's budget. But first, President Biden is set to hike tariffs on a range of Chinese goods this week, with EVs in the crosshairs. We'll have the details next. This is Bloomberg. The Biden administration is set to significantly hike tariffs this week on some Chinese goods, including nearly quadrupling duties on Chinese-made electric vehicles. Our Chief North Asia correspondent Stephen Engler is here with the details. And Steve, as you were saying last hour, some of these products that are being considered aren't big exports anyway to the US. So is this sort of more bark than bite?
Well, it's a lot of politics. It's an election year, you might have heard, in the United States. And the UAW and Trump has been harping on tariffs as well. well. So Biden is taking a little bit of a tougher line on, of course, Xi Jinping's new 3, which is the green tech exports and their overcapacity. And, of course, Chinese manufacturers who are, seeing their margins get crimped quite badly and their profitability is non-existent right now. They're trying to export this excess capacity. But Biden administration sort of sticking their fork in the ground and saying, nope, not going to come here because, again, it's a political year. Keep in mind as well, though, only about, according to Edmunds.com, only about 1% of all vehicles on the roads in the United States are EVs. And it looks like Detroit is kind of pulling back from that wave of enthusiasm towards EVs. Tesla is seeing some trouble. Its stock is down 32% this year. Ford only made about 76,000 or sold 76,000 EVs last year. The pace of growth is down considerably overall for EVs. So as David Fickling, if you read his columns of Bloomberg Opinion, he says, boy, the industry or the country that made the automobile industry is sort of losing its nerve towards EVs right now. Now, that's kind of the backstory to what's happening with these tariffs. We're hearing from sources, and it could be announced as early as Tuesday this week, that the Biden administration will raise the tariffs on Chinese-made EVs to 102.5% from 27.5%. That's an increase of 272%. There also could be a doubling or a tripling of duties on other products made in China, whether that's solar cells, batteries. We already heard about steel and aluminum. There might be a bit of a reprieve for solar cell manufacturing equipment, as that's been asked for by the U.S. solar industry.
Steve, does this differentiate from what we've heard from Trump?
Well, Trump wants an even tougher tariff regime on these products, and he sort of mocked Biden's goal of quadrupling the EVs, Chinese-made EV tariffs. He says he'd probably raise it up to about 200% and warned about the possibility of Chinese manufacturers making these EVs in Mexico and then under the U.S.-Mexico-Canada agreement, exporting them to the United States. That's why Trump says he would put 200% tariffs, not 102.5%. And again, Trump has said he wants to impose across-the-board 60% tariffs on all Chinese imports. We'll have to see how that comes to play and whether that is a significant talking point on this campaign that's sure to heat up over the next 6 months.
Chief North Asia correspondent Stephen Angle there. And don't miss an exclusive interview with the US Treasury Secretary Janet Yellen on the US-China relationship. But that's on Monday at 10 p.m. Hong Kong, live on Bloomberg TV and radio. All of this comes as the Treasury is forecasting that Australian inflation could return to the central bank's target band before year-end. Australian Treasurer Jim Chalmers told us about the government's spending priorities in his only international interview with television ahead of Tuesday's budget.
I think we've got to strike a finer balance in this budget between the near term and the longer term. Also making sure we can provide that cost of living relief for people who are doing it really tough at the moment at the same time as we invest in a future made in Australia. So it'll be a responsible budget. It will ease cost of living pressures, but it will also invest in the future. And obviously forecasting inflation at the moment is tricky. It's tricky at the best of times. But what the budget will do is it will put downward pressure on inflation rather than upward pressure on inflation. Yeah, we've made substantial progress here in Australia in the fight against inflation, but it's not mission accomplished because people are still doing it tough. And so the budget will be very focused on that.
Obviously, over the past six months or so since you've been putting this budget together, the outlook for inflation has changed quite a lot. Has that changed your thinking on the way you've put the budget together?
We're making that progress in the fight against inflation. We know that it needs to be the primary focus, particularly at the front end of the budget. And that's why you'll see substantial spending restraint. You'll see our cost of living measures designed in a way that takes the edge off inflation rather than adds to inflation, so that overall our budget will be part of the solution to inflation rather than part of the problem.
Now, moving on to a future made in Australia, that's going to be a big part of this budget. How does the future made in Australia, how does that differ from the IRA in the United States?
Yeah, what we're trying to do here is to make sure that Australia grabs the vast economic and industrial opportunities from the global shift to net zero. And the sorts of things that we are contemplating are not out of place, whether it's in the United States or indeed in most of the developed world. But for Australia, we've got some huge advantages. You know, we've been dealt some incredible cards. Our resources base, our industrial base, energy, our human capital base, our attractiveness as an investment destination. And so what a future made in Australia is all about is not replacing private investment in the opportunities of the future, but attracting more of it. That will require some public investment, and we need to make sure we get value for money for that. We've got our own unique set of advantages as the economy changes, the global economy, and the pace of that change accelerates. We want to make the most of it. We want to create good, secure, well-paid jobs and prosperity into the future. And that requires us to renew and broaden and deepen our industrial base.
But you mentioned, obviously, Australia's unique advantages, but isn't Australia coming too late to this? I mean, a lot of the people we'll be competing against, a lot of the other countries, you know, our partners, have had these policies in place for quite some time.
Well, we better get cracking then, and we will on Tuesday. We have made substantial investments already in our ambitions to become a renewable energy superpower, which is really at the core of a future made in Australia. The global economy of the future will be powered by cleaner and cheaper energy, and we've got a big role to play in supplying that to become a reliable supplier of that energy. But there is more that needs to be done. A combination of tax incentives, targeted grants, making sure that we've got the architecture to attract and absorb and deploy all of this private investment. You'll see a lot of that on Tuesday night.
Now, on to critical minerals, which is part of this. You've announced $500 million so far for exploration for critical minerals. Is that all that we're expecting for critical minerals in this budget, or should we expect more on Tuesday?
Oh, you should expect more on Tuesday. Critical minerals are the opportunity of a century for Australia. This is genuinely a golden opportunity for Australia. Our critical minerals space is one of the reasons why there is so much attention from global and domestic investors. But we need to make sure that we can attract and deploy that. The exploration is an important part of that. That geoscience, open source science to map Australia, our groundwater, our critical minerals opportunities, a big important part of it, but there'll be more.
Speaking of global opportunities, China, we're starting to see a few green shoots in their economy, but for Australia, we'd like to see a lot more, I'm sure. From your conversations around the world ahead of this budget, but ahead of the rest of the year, are you expecting to see more stimulus in the Chinese economy as the year goes forward?
I think there's certainly a prospect of that. Our budget will forecast Chinese growth with a 4 in front of it in the near term, and if that eventuates, that'll be the weakest period of growth of that length since China began opening up in the late 1970s. And so the Chinese economy has been soft. The property sector has been a big part of that, but not the only part of that. And that weakness has kind of offset in our global forecast the strength we've seen in the US.
That was the Australian Treasurer Jim Chalmers speaking with Bloomberg's Ben Westcott in Canberra, and we'll have more to come on Daybreak Asia. This is Bloomberg. Some of the geopolitical developments that we're tracking this morning in the Philippines says China has deployed vessels and divers to explore a shoal in the South China Sea for reclamation. The nation's Coast Guard says it sent a patrol ship to what Manila calls a Skoda shoal to deter China's activities. The area is close to the Philippines' Palawan Island, which directly faces the contested waters. The development adds to growing tensions between Manila and Beijing. The US says Israel risks fueling a post-war insurgency in Gaza, with thousands of armed militants remaining in the territory, even if Israeli forces invade Rafah. Israel says it now has evacuated the eastern part of the city, or eastern third of the city, as it prepares to expand its military operation. Last week, the US said it would withhold weapons that may be used in Rafah and cited evidence that Israel has breached international laws protecting civilians. Russian President Vladimir Putin has replaced his long-serving defense minister in a surprise move. Sergei Shoigu had been in the post since 2012. The reshuffle is the first major shake-up of the Kremlin's military leadership since the Ukraine invasion and comes as Russian forces seek to capitalize on a battlefield advantage in the war. And we're going to be speaking exclusively later to French President Emmanuel Macron about the war, trade, geopolitics and international investment. That's at 1 a.m. Tuesday, Hong Kong time.
Take a look at how we're tracking, about half an hour into the start of trading in Japan, Korea and here in Australia. A little bit of downside, pretty muted start to the trading week, really. Japan stocks and Nikkei down by just about 0.3%. We're seeing a little bit of a boost when it comes to the Kospi, and broadly we're seeing downside for Australian stocks, about 0.25% softer. This is a market, though, coming off about 3 weeks of gains, so perhaps a little bit of a breather being taken here. New Zealand also down by about 0.6% there. Some of the stocks that we're watching, Shiseido is one of them. Of course, we're still in the thick of earnings season across many of these markets. Shiseido seeing a bump of about 6% there, rising on that first quarter core operating profit beat that we're seeing. In fact, off the session highs, it was up by about 7%, which is the most in about a year and a half. And against the broader declines that we're seeing in the topics there, those shares are up about 11% this year. First impressions, according to the likes of Nomura, saying slightly positive. We're seeing that positive reaction across the share price. Olympus also gaining by about 5.7% there. One of the stocks we're watching here in Australia and seeing some downside reaction is ANZ. The lender saying that the Australian Securities and Investments Commission is investigating the bank's execution of a government bond issuance last year. Our finance editor, Adam Haig, joins us now with the details. So, Adam, what's being investigated? What's going on here?
Well, at this point, Heidi, what we know is that ASIC are looking into what happened during the sale of some government debt in Australia last year and ANZ's role in that. So it's quite typical for banks, typically through a syndicate, a number of banks together to be involved in the sale of government bonds. But something seems to have picked up some kind of irregularity in what happened in one of these sales last year. So what we know is that ASIC, the main markets regulator now, is looking into one of these sales last year, and specifically ANZ's role in that. So they're the really kind of basic mechanics of what's happened and what's come out in the last few hours, but really it begs quite a lot of questions now, which we'll hope to answer in the coming days and weeks, about what really did happen during the trading of this. Was it at the time? Was it something that happened subsequently? And indeed, what were the other banks that were involved in this? Is this something that's just isolated to ANZ, or were there other firms involved in these sales that also look in some way irregular as well? So there's some of the things we'll be looking at. And of course, the broader context here is that this isn't the first time an Australian bank has been involved in accusations of impropriety in markets like these. So if you cast your memory back a good few years now to the bank bill swap rate inquiries, that were cases taken to court by ASIC for not just ANZ but for some other banks as well, around irregular trading that existed in those markets. So it does bring back memories of some of those problems associated with what happened in those markets, but it's too early to tell just exactly what's happened now. We really need to try and dig into the details and understand what was ANZ's role in this government bond sale, and indeed what are the specifics of the irregularities that happened that have prompted ASIC to look further and investigate just what's happened.
ANZ says that it's cooperating fully here, but do we get a sense of what the investigation would really look like and how long it could take, and as well touch a bit more on the possible penalties here?
Yeah, it's a little bit early to tell, really, Annabelle, on all of those fronts. But clearly the bank is cooperating with the regulator, as you would expect. The question is what that level of interaction and communication is. You know, are they really drilling down into some specific one-off irregularity that they found, or is it more about a series of events that happened over time? It's too early to know that yet, and therefore it's really too early to throw around any numbers in terms of what might result out of this or any potential penalties further down the line. We just don't know enough about what happened, what went wrong, and indeed why it went wrong, and to get any assessment of that yet. But of course that's really what we'll be looking at, and some of the real key details that we'll want to drill into and try and find out in coming days.
That was our finance editor, Adam Hay there. Of course, the story we're tracking closely this morning in ANZ shares under pressure. Sticking with the equity markets, you're taking a look here at the moves that we've seen really to the upside for China and Hong Kong stocks so far this year, up more than 9% actually over the course of 2024. So on a par with the S&P 500. That comes after 3 brutal years that saw major Chinese indices plunge more than 40%. Let's bring in our Asia stocks reporter, Sang-Mi Cha, joining us. And Sang-Mi, there's been so much optimism around this. We've seen policy support coming through from the Politburo. There's been better economic numbers that are coming out. How much longer or further can we go from here?
That's right. We've been seeing that rally coming, and it's on the back of those blazing tech rally. Of course, we're going to be seeing those earnings of Tencent, Alibaba, JD.com, and Baidu coming all this week. And all these 4 companies actually make up more than a quarter of the MSCI China index, right? So they are the ones that have been actually pushing these indices up to be on par with the S&P 500, just like you said. And there are so many of the aspects that are coming in. Optimism, especially with the Chinese government rolling out more of these good news, more of these subsidies and these announcements in the property sector. And we have the dollar peg that the Hong Kong dollars pegging to the U.S. dollars. There's just so many of these aspects that are looking good for these equities rally. But then, of course, there are some of the concerns. Some of the analysts are saying that there is a concern over these equities being overbought now that a lot of the foreign investors are just coming in and with this fear of missing out, and then they're saying that it could be a bit of a tactical rally for the time being. So we still need to watch out for all of these matters, especially the geopolitical tensions with the U.S. is still the space that we're watching very carefully.
China's had to switch off a live feed for foreign flows for stocks as early as Monday. So we've had some sort of advance warning of this. What are you watching in terms of the reaction?
That's right. So the Chinese government decided to switch off, or they're planning to switch off as early as today, these live feed of the purchases and sales of the local stocks from foreign investors. So in the past, we were able to trace that real time, but now they're going to turn it into a daily basis turnover release. So that's going to be on par with international standards. That's what the authorities are saying. But it would be a difference there as not every fund will be able to watch the real-time data. Of course, the stocks they rallied after this announcement because the retailers in China have been wanting for this to happen, as this has fueled some of that negativity in the real-time data. So we'll be seeing how the equities react to that today. And of course, we're also watching Biden's tariff woes, as he has, our U.S. colleagues have reported on Friday that he is potentially going to be releasing more of that tariffs on solar cells, EV makers, or battery makers for China. So we're watching BYD, CATL, and Long E shares.
That was our Asia stocks reporter, Sang-Mi Cha there, and we'll have more to come on Daybreak Australia, or Asia rather. This is Bloomberg.
Well, Asia's earnings spotlight shifting this week to China's internet giants. Alibaba and Tencent could report single-digit revenue growth last quarter, according to analyst estimates. Bloomberg Intelligence is also expecting slower first-quarter ad growth for Baidu and better margins for JD.com. We'll also be hearing from Japan's mega banks this week as well. They could see a jump in their annual profits. And the one we're watching later on Monday, SoftBank will probably report trimmed losses as the Vision funds return to profit. Our next guest sees SoftBank as a strongly growing but misunderstood stock and therefore undervalued. Let's get more insight with Richard Kay, who's a portfolio manager at Comgest Asset Management. Richard, tell us why you're constructive on SoftBank.
Thanks very much, Heidi. I think that the two great businesses that are driving SoftBank today are Arm, something like 20% of organic profits, and then the Japan businesses, which are the telecom business, the Yahoo and the Line combination, and that's growing something like 16, 17% in organic profit terms. And a company that's growing as strongly as that, but is misunderstood and is trading on real organic price earnings, probably single digit, low double digit, is a very attractive investment proposition. Everyone talked about the Vision Fund. You talked about it just now. Vision Fund is massively important, but it's very hard to assess the Vision Fund quarter to quarter. As you know, they mark to market their valuations on the investee companies. It's a little bit hard to gauge the overall direction just from that. We think the Vision Fund is going to be a massive long-term story for SoftBank, but those two core businesses, I repeat, Arm and the Japan businesses, are really the drivers right now, and they're driving a very stable, visible profit growth for which you don't have to pay very much for this misunderstood company, in our view.
It's interesting. We've seen a US-listed portfolio when it comes to Vision Fund shrink by $29 billion since the end of 2021. It's been sort of a series of quiet sales and write-downs. The strategy has really pivoted to chips and AI. Is it sort of any wonder, I guess, that perhaps SoftBank is misunderstood given this big pivot away from the aggressive VC strategy?
It's a great question, Heidi. Thank you. And it is true that SoftBank has changed a little bit its direction. It's done that many times during its life. Remember that the exits that it's made on the Vision Fund, the actual cash exits, have all been positive. It's got a positive return on those, so the investment track is very good. And the money that it's made, it's deploying in slightly different directions, including what you mentioned just now, which is Arm's proposal to enter AI chips. That's not a totally different direction. Arm obviously is the major, almost exclusive supplier of chip architecture for mobile and increasingly server applications. To go into making chips is slightly new, but it looks like they'll be using outsourcing arrangements that won't actually be buying semiconductor infrastructure themselves. It's a slightly new direction. It's a new tilt, but it brings together all of SoftBank's amazing resources, obviously with Arm and other companies in the semiconductor supply chain, and the many users of that semiconductor technology, including potentially automated driving on its rideshare services, and of course energy through many energy-related investments that it's made. Yes, there's something of a change of policy, but the fundamental idea of investing massively and early in pioneering and changing platforms, that fundamental idea has always defined SoftBank and defines SoftBank today.
If you're saying SoftBank is undervalued, what do you think is the true value then that investors should be putting on the stock?
There are two ways to answer that, Annabelle. I think that if you simply look at the price earnings multiple and look at the comparable multiple for, internet global megas and the growth that this company is giving, it could easily be a two-bagger. It's probably 50% undervalued right now. Another way to answer the question is to look at the net asset value. All of these things we're talking about, Arm, the Vision Fund stakes, and so on. And on a net asset value basis, SoftBank is probably even more undervalued than what I just said. It's probably 60, 70% undervalued. So it could be more than a two-bagger. Again, I say this is one of the most misunderstood large Japanese companies. It's growing fine. Even on visible earnings, it's undervalued. And then the potential in the Vision Fund, in our view, is very large, including in this new announcement of potentially moving to AI semiconductors.
How many other misunderstood companies or undervalued companies do you see across Japan's tech landscape?
Well, a ton is the simple answer. We've got about $1 billion worth of investments in Japan's semiconductor space. Companies that make chips, companies that make the equipment that make chips, make the materials that make chips, and of course SoftBank, which has all of this exposure to the semiconductor supply chain. And that $1 billion that we hold worth of Japanese semiconductor stocks, things from Lasertec to Tokyo Electron to Shinetsu Chemical to Kokusai Electric, recently listed company in semiconductor equipment. We think that those things are all undervalued and misunderstood, partly because they're in Japan and people don't realize perhaps that they are global major companies, that they're indispensable to the supply chain, that when Intel, TSMC throw up factories in Columbus, Ohio, in Taiwan, or in Arizona, these companies are vital parts of the design and the manufacture which these global companies are using. And so we think that semiconductor space generally is a particularly undervalued opportunity within the Japanese market. Stepping back a little bit, the Japanese market in the last year or so has been led very much by a few sectors like banks and commodities stocks and cheap yen plays. We think the market is probably due for something of a leadership change, and these semiconductor stocks, undervalued, misunderstood, could well be new leaders of the market into the next phase of the market's appreciation, we suggest.
All right, that was Richard Kay, portfolio manager at Comgest Asset Management. And let's actually think about who the market leadership is being driven by in China, and that's very much the tech space. A lot of the moves or the run-up we've seen in Chinese equities predicated on the moves that we've had in big tech there as well. And Alibaba, Tencent, among those that are going to be reporting their results on Tuesday. Let's get a preview from our tech reporter, Jieping Wang, who joins us here in Hong Kong this morning. And Jieping, let's just start with Alibaba here. What are we expecting, and probably a particular focus on the AI front as well?
Mm-hmm. Yeah, we haven't had Alibaba and Tencent reporting on the same day for years, so it'll be exciting. I guess investors will really be comparing their results side by side. Actually, because we've been reading their results as a barometer for the Chinese economy, which isn't doing so great, right? We have a couple of issues. So for Alibaba, yes, the bottom line is their e-commerce, and then on top of that, AI. It made its AI large language model open source. That means more developers will be using their services. And actually, it's a strategy mirroring Microsoft. When developers jump in on their AI platform, it will contribute more cloud revenue for Alibaba. So yeah, I guess in Alibaba's case, the e-commerce will give us a sign where Chinese consumer spending are standing. And then on the cloud side, we'll see if it can compete against other model makers like Tencent and like Baidu.
Yeah, tell us about what we're expecting for Tencent. And, these two companies are really pretty major barometers for the broader economic recovery story.
Yeah, for Tencent, the growth is pretty much centered around WeChat, the all-in-one platform, right? We have a TikTok-style short video feed in WeChat, and we have live shopping and mini games that will contribute to their advertising and in-game purchases. And also, because WeChat has this mini program ecosystem, and that's also a major part for Tencent's cloud revenue. So it's sort of like Tencent's growth is too much put into one egg, and at the same time, Tencent's main gaming business isn't doing so great. Its gaming portfolio is Asian. We have Honor of Kings and Peacekeeper Elite. These are all years old, and the executives told us last time the gaming revenue will really be picking up from Q2. That means in this past quarter, we'll probably still see a sign of weakness in their bread and butter division.
All right, Jieping, as you said, Tencent, Alibaba, first time we've seen them reporting on the same day in a number of quarters. Right. All right, that was our tech reporter there, Jieping Wang. In Hong Kong, we'll have more ahead on Daybreak Asia. This is Bloomberg. All right, quick check on some of the results of our latest MLive poll survey. And this one here taking a look at whether the yen is still a safe haven currency. And you can see here the majority of respondents saying that no, and a little bit unsurprising, of course, and some of the respondents that we had to that survey really citing Japan's ultra-easy monetary policy, and that has been really driving that big weakness that we've seen in the Japanese yen this morning around that 156 level. So the dollar is still seen as the best haven currency, Swiss franc as well, getting about 23% of the vote. Let's change on, because where we are also looking at in the survey is inflation hedges, and actually this one was more of the interesting findings. No, the majority are saying that large cap or big tech is not an effective recession hedge, but still you've got nearly 40% saying that US tech stocks not only a bet on possible hedge, as I said, against price pressures, but also, of course, that traditional bet on innovation. And really key to the US tech space has been some of the moves that we've seen in chip stocks and semiconductors in particular. It does come down to that race that we see between major superpowers, and you've got the US, the European Union, they've funneled nearly $81 billion into producing the next generation of semiconductors, and it does escalate that global slowdown with China for chip supremacy. Our US industrial policy reporter Mackenzie Hawkins joins us for more on today's Big Take. And Mackenzie, we've seen so much money, as we said, coming through from the US, from Europe. Even we had some announcements from Korea over the weekend, Japan as well. How much does that stack up against the level and the size of the investment that's coming through from China?
It's a great question. So a lot of these countries are really playing catch up to decades of Chinese industrial policy in this space. You know, we've estimated, based on estimates from the Semiconductor Industry Association, China's on track to invest $142 billion into chip making. That's compared to $39 billion from the U.S., which is the most robust program that we've seen from the West. So it's a lot of catch up, but we are seeing investments into different types of technologies. In the U.S. and the European Union, they're pursuing the most advanced semiconductors, while China is doubling down on older generation chips.
How are we seeing the issue of export controls come into play here?
So until 2019, when the U.S. blacklisted Huawei, Huawei is actually catching up to its Western competitors on the most advanced chip design technology. But with that initial sanction and then U.S. sanctions on Huawei's chipmaker SMIC, and then sweeping export controls that were initially implemented in 2022 and have ratcheted up over the past couple of years, that's really halted China almost in its tracks on producing the most advanced chips. And so the response that you've seen from Beijing is, one, to double down on state aid to its prize technology companies, but two, to focus on the areas where they can win. And in this case, that's in older generation semiconductors, sometimes called legacy chips, that are still essential commodity chips that go into every piece of technology you can think of. And there's actually worry now from the US and the European Union that China will produce so many of those chips. They have the most chip-making plants set to open of any country in the world over the next couple of years, that could create a glut.
Our U.S. industrial policy reporter Mackenzie Hawkins there on our Big Take. Let's take a look at how our futures are setting up. This is a picture when it comes to trading in the U.S. Of course, it was a pretty lackluster end to Wall Street session. The consumer confidence, the consumer numbers, I should say, as well as really setting up for expectations of inflation data out this week, will really kind of determine which direction this market goes in next. We're looking pretty flat at the moment. We're seeing TAIEX futures up about 0.7%. FTSE China futures also not doing very much. Of course, we're still really percolating through the disappointing credit data that we had from China over the weekend. Dollar China trading pretty steady at this point. That is it for Daybreak Asia. The China Show is next.